Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
Imagine analyzing this massive regional bank, right? One holding a $16 billion loan portfolio.
Okay, sounds like a pretty standard financial review.
Right, but instead of, a fancy marble lobby, the tellers are just surrounded by tens of thousands of used Honda Civics and Ford F-150s.
Yeah, that is really the ultimate paradox of the company we are diving into today. Because most people, they just see those big blue and yellow signs on the highway and they assume, oh, it's just a giant car lot.
Exactly, but then when you actually sit down and dissect the financials, you realize a massive percentage of the company's valuation is tied entirely to this, captive finance arm operating behind the scenes.
It really is an invisible engine.
So today we are doing a deep dive into CarMax, stock ticker KMX. And our mission here is to really break down the mechanics of the undisputed heavyweight of the used car market.
And we have some incredibly detailed source material for this. We are pulling our insights from a brand new research report from Compasscope.
Which is fantastic, along with the raw, unfiltered commentary from CarMax's recent Q4 2026 earnings call.
Right.
And for you listening, whether you are actively tracking consumer discretionary stocks or you're just, fascinated by business model pivots, our goal today is to bypass all that dense Wall Street jargon. We want to focus on how this machine actually generates cash.
Because to understand that cash generation, you really have to look at their structural foundation first. I mean, CarMax is the nation's largest omnichannel used car retailer.
Right. They operate over 250 physical locations now.
Exactly. And their core pitch to the consumer has always been this no-haggle pricing and a single associate sales model.
I actually want to pause on that single associate model for a second, because on the surface, it just sounds like a nice customer service perk.
Yeah, you don't have to deal with the stereotypical car salesman.
Right. But financially, it completely alters their incentive structure. Because in a traditional dealership, a salesperson is highly motivated to push you into a high-margin vehicle.
Oh, absolutely.
And then after that, they hand you off to a finance manager whose entire job is to just squeeze more margin out of the loan terms. But at CarMax, the associate gets a flat commission, right?
Yes, exactly. Regardless of whether you buy a $15,000 compact car or a $50,000 truck, their pay is the same. They don't even know the profit margin on the specific car they are selling you.
Wow. So they're completely blind to the margin.
Totally blind. And that structure is designed purely for velocity. By removing that informational asymmetry and, that horrible 4-hour negotiation standoff, CarMax dramatically increases the number of transactions an associate can handle in a single shift.
So they are prioritizing inventory turnover over maximizing the gross margin on any individual vehicle.
Right. But the vehicle itself, well, that's only the first revenue stream. The ancillary products attached to that vehicle are really the critical profit drivers here.
Yeah, the Compasscope report highlights their extended protection plans. Specifically, there is MaxCare for mechanical breakdowns and this newly introduced MaxCare Plus, which adds cosmetic coverage.
And we need to be clear, these are not just minor add-ons.
No, not at all. Compasscope notes that CarMax is actually targeting an incremental $35 per retail unit in margins just from the nationwide rollout of MaxCare Plus in fiscal year 2027.
Which is huge. I mean, when you multiply $35 across hundreds of thousands of retail units, that drops a highly profitable, high-margin revenue stream straight to the bottom line.
Exactly. But then you also have to consider the vehicles that never even make it to the retail lot.
Right, the wholesale side. CarMax is quietly one of the largest wholesale auctioneers in the country.
Which blew my mind. They buy up to 1 million vehicles a year directly from consumers through that We'll Buy Your Car program, right?
Yeah, up to 1 million. And if a vehicle doesn't meet their strict retail standards, like maybe the mileage is just too high or the frame is slightly compromised, they just auction it off to licensed dealers.
And the sell-through rate on those wholesale auctions is what really caught my eye in the data. They sell over 95% of what they put on the block.
That is a staggering number.
Yeah, it is. Especially when the industry average at other large auction peers is closer to 60%.
Right. And what that tells you is their appraisal algorithms are just highly dialed in. They know exactly what a wholesale buyer will pay before they even make that initial offer to the consumer sitting in their driveway.
And having that precision acts as a massive risk mitigant, doesn't it?
Absolutely. It means they can confidently extend an offer on virtually any car, knowing they have an immediate, highly efficient disposal channel if it doesn't fit the retail profile.
Which brings us to the financial engine powering the entire retail side, CarMax Auto Finance, or CF.
Ah, the invisible bank we mentioned earlier.
Exactly. CF finances over 40% of CarMax's retail sales. They manage an average loan portfolio north of $16 billion.
It's massive. CompassScope actually estimates that CF accounts for roughly 46% of CarMax's total fair value.
Let's unpack how this actually works for the listener, though, because
Yeah.
they aren't just, holding all $16 billion of those loans on their own balance sheet and waiting 5 years to collect the interest from it.
No. That would tie up way too much capital.
Mm.
Instead, they utilize a process called securitization.
Okay, break that down for us.
So when CarMax originates a car loan for a consumer, they bundle thousands of those individual loans together into a single financial product, a security.
Right.
And then they sell that bundled security off to institutional investors through these special purpose entities.
Okay, so they basically get the cash up front from the investors, and then they immediately use that cash to go buy more used cars to put on the lot.
Precisely. They replenish their capital instantly.
Yeah.
But here's the kicker. They also retain the servicing rights, and they capture a portion of the interest rate spread over time.
Wow, so it transforms their capital into this high-velocity loop.
Exactly. And because they are sourcing over 70% of the retail units directly from consumers now, which is up from like 30 to 40% pre-pandemic, they have effectively insulated themselves from the volatility of third-party wholesale auctions.
Meaning they completely control their own raw material supply chain.
Yes, and that level of self-sufficiency is a massive operational moat. But, the competitive landscape is certainly not standing still.
Right, you've got major franchise dealers out there, like Sonic with their EchoPark brand or AutoNation USA. They are really trying to carve out dedicated used car footprints.
They are, and franchise dealers do possess a distinct advantage in diversification. I mean, they have the safety net of new car sales, lucrative manufacturer incentives, and those massive high-margin parts and service departments.
So if the used car market softens, they have other levers to pull to sustain their revenue.
Exactly. However, the CompassScope analysis suggests that varied diversification prevents them from achieving CarMax's pure, singular focus on optimizing just the used car ecosystem.
Makes sense. And then, of course, we have the digital-only platforms, the startups that popularized buying a car entirely on your phone and having it delivered to your house on a flatbed truck.
Right, the disruptors.
They have undeniably slick user experiences, but I constantly find myself questioning the long-term viability of their physical logistics.
Well, you are not alone there. The digital platforms definitely forced the entire industry to upgrade its e-commerce capabilities. But the vulnerability of that digital-only model is just the sheer cost of transportation.
Yeah, shipping a single 2-ton asset across 3 states from some centralized hub to a single buyer, that burns a tremendous amount of cash.
It really does.
But let me challenge that from the other side for a second. With consumer behavior clearly shifting toward digital, doesn't CarMax massive real estate footprint, I mean, those 250 huge, brightly lit physical lots, doesn't that start to look like a bloated fixed cost?
It's a fair question.
Yeah.
Why carry all that real estate overhead when people just want to buy on their phones? But the physical real estate is largely misunderstood by digital purists. Those 250 lots are not just showrooms. They are a decentralized logistics network.
Oh, okay.
Having inventory distributed all across the country allows CarMax to execute nationwide vehicle transfers highly efficiently. It enables their 24-hour test drives and their 10-day money-back guarantees without incurring those catastrophic shipping losses on returns.
So they're essentially leveraging the physical footprint to make the digital experience actually profitable.
Exactly. And those physical locations are also where the heavy lifting of reconditioning happens. The sources detail how CarMax utilizes this Toyota-style single-piece flow reconditioning.
Right, and for you listening who might be unfamiliar with manufacturing theory, this basically means instead of one mechanic taking a car into a bay and spending 3 days fixing everything on it, the car moves through a highly specialized assembly line.
Right. One station only does brakes, the next station only does cosmetic touch-ups.
It's just constant movement.
And by breaking the reconditioning process into standardized sequential steps, they structurally lower both the cost and the time it takes to get a car frontline ready.
Because every day a car sits in a mechanic's bay is a day of lost interest and active depreciation.
Exactly. Single-piece flow minimizes that trapped capital. And when you combine that physical efficiency with their 30 years of proprietary pricing, appraisal, and transaction data,
You end up with a pricing algorithm that dictates exactly what to pay and what to charge to maximize turnover.
Precisely, which feeds directly into their current growth strategy. Because right now, they are actively tweaking that algorithm.
Yeah, we are seeing a massive shift right now. CarMax is deliberately choosing volume over margin. They are intentionally compressing their gross profit per unit or GPU to force sales volume back up.
Well, used cars became historically expensive over the last few years, right? Yeah. It created a severe affordability crisis for the average consumer.
It really did.
So CarMax's response is this value max shift. They are aggressively sourcing and selling older, higher mileage vehicles to bring the absolute transaction price down to a level the consumer can actually afford to finance.
But discounting the metal, like that puts intense pressure on the bottom line. So to offset that lower gross profit per unit, they are executing a pretty severe financial restructuring.
Right, the cost cuts.
Yeah, they are targeting a $200 million exit rate reduction in selling, general, and administrative expenses, SG&A, by fiscal year 2027.
And on the finance side, they are pushing further down the credit spectrum. They're aggressively expanding their lending into the top half of Tier 2 credit.
Okay, so by expanding into Tier 2, they are offering financing to buyers with slightly lower credit scores.
Yeah, because if you are dropping the price of the cars to attract buyers, you also have to ensure those buyers can actually secure a loan. Otherwise, the volume just doesn't materialize.
But the math here is incredibly tight. I mean, if you drop your margin by $200 a car, you have to sell a massive amount of additional inventory just to break even on the gross profit dollars you voluntarily gave up.
It relies entirely on flawless operational execution.
Right, because if that promised $200 million in SG&A cuts gets eaten up by inflation, or if the reconditioning assembly line slows down, the operating margins will just collapse.
And that execution risk is currently the central debate among analysts right now, and it is complicated by a major leadership transition.
Oh, yeah. CarMax recently brought in a brand new CEO, Keith Barr, and his prior role was the CEO of IHG Hotels and Resorts.
Which is fascinating.
I mean, I have to throw a red flag on this. An executive from the hospitality industry is taking over a used car retailer during one of the most volatile macroeconomic transitions in the auto sector's history.
It sounds a bit crazy, I know.
How does a background in booking hotel rooms translate to managing asset depreciation and subprime auto loans?
It looks deeply counterintuitive until you actually read his commentary on the Q4 earnings call.
Okay, sell me on it.
Well, the core operational challenge of modern hospitality is mapping the customer journey to reduce friction and maximize digital funnel conversion. Barr's expertise is not in managing the physical asset. It is in optimizing the e-commerce interface.
So analyzing how many clicks it takes a user to go from like looking at a car on their phone to actually signing the finance agreement.
Exactly. CarMax already possesses the physical infrastructure and the inventory sourcing engine. Both Compasscope and Barr acknowledge that their primary bottleneck right now is the digital user experience.
Ah, I see. So if millions of people are visiting the website, but the friction of the digital checkout process causes them to just abandon the cart, that is lost revenue.
Right. Skills honed in hospitality like seamless check-ins, transparent pricing, intuitive digital interfaces, those are actually highly transferable to solving CarMax's omnichannel conversion problem.
Okay, I see the strategic logic for the digital funnel. But the execution risks on the balance sheet are still glaring to me, particularly regarding that Tier 2 credit expansion.
You mean the credit risk?
Yeah. You are deliberately originating loans to higher risk borrowers during an inflationary period defined by consumer stress.
And that requires really close monitoring of their loan loss provisions.
Right, because when CarMax Auto Finance originates a portfolio of riskier loans, accounting rules require them to set aside a certain amount of capital, a provision, to cover the loans they statistically expect to default.
Exactly. And if inflation bites harder than their internal models predict, and those Tier 2 consumers start defaulting on their payments at a higher rate, CAF have to increase those provisions.
Which directly wipes out earnings.
It does. And we can actually see the real-time cost of this volume over margin pivot in the Q4 2026 earnings numbers.
Yeah, let's look at those numbers. Total sales came in at $5.9 billion. Used unit comparable sales were down 1.9%.
Now, generally, negative growth is nothing to cheer about.
Right. But for you listening and tracking the trajectory, this is actually a massive operational victory because in Q2 and Q3, comps were down 6.3% and 9% respectively. So narrowing that to negative 1.9% indicates the bleeding has largely stopped.
The stabilization is real, but management paid a steep price to achieve it.
They sure did.
To stimulate that sales recovery, they deliberately dropped the retail gross profit per unit by $207, bringing it down to $2,115 per vehicle.
They basically sacrificed profit margin to buy market share and keep the inventory moving.
Right, and the bottom line absorbed the impact. Earnings per share took a severe $1.19 hit in Q4.
Now, the sources break this down into two distinct charges. There's a 20-cent restructuring charge tied to corporate workforce reductions and abandoning their office space in Edmonds.
And then there's the big one, a 99-cent non-cash goodwill impairment.
Right, and I want to unpack that goodwill impairment for you listening because, it sounds catastrophic, but it really requires context.
It does.
So explain how a non-cash charge destroys earnings on paper but doesn't actually affect the company's bank account.
Well, goodwill is an accounting mechanism. When a company acquires another business or an asset for a price higher than its tangible book value, that premium is recorded on the balance sheet as goodwill.
Okay, so it represents intangible value like brand reputation or proprietary tech.
Exactly. However, when market conditions sour or the acquired asset underperforms, accounting rules force the company to write down or impair that value.
So it doesn't mean CarMax wrote a check for that amount in Q4.
No, not at all. It doesn't drain their current cash pile. But it is a formal admission to investors that past investments are no longer worth what management originally thought.
It's an accounting reality check, basically.
Exactly. But despite the messy earnings report, the Q4 call did offer a glimpse into Keith Barr's early tenure.
Yeah, even with just a few weeks in the seat, his focus was hyper-targeted on making CarMax the path of least resistance.
He heavily emphasized applying artificial intelligence to inventory matching, like ensuring the algorithm puts the right car on the right physical lot at the optimal price.
And further blurring the lines between their digital interface and the physical test drive.
Which leads us to the crucial metrics for anyone tracking this stock going forward. Connecting all these strategic dots, the first key to watch is macro affordability.
Right. You have to monitor the trajectory of auto loan interest rates and used vehicle prices relative to everyday household incomes.
Because if the math simply doesn't work for the consumer, internal optimization won't force a massive sales boom.
True. Internally, though, the execution of the cost savings is paramount. Management promised that $200 million exit rate reduction in SG&A by fiscal year 2027.
We really need to track whether those operational savings actually materialize on the bottom line, or if they're quietly absorbed by inflation, rising logistics costs, or, executive compensation.
Yep. The third metric is credit quality.
Right. As CarMax Auto Finance absorbs a higher volume of Tier 2 loans, the delinquency rates and those loan loss provisions we discussed, they become the canary in the coal mine.
Right. Are their underwriting algorithms accurately pricing the risk they're taking on, or will a spike in defaults just catch them completely off guard?
And finally, we have to watch the digital conversion rate. This is Keith Barr's proving ground.
We need to see tangible metrics in the upcoming quarter showing that the website traffic is actively converting into completed sales contracts under his leadership.
Because if he can streamline that digital funnel and improve the conversion rate even marginally across a network of over 250 stores, the operating leverage will just be tremendous.
It is a delicate balancing act of volume, margin, and credit risk.
It is. But I want to leave you with a larger, lingering thought based on everything we've unpacked today.
Let's hear it.
As the entire automotive industry becomes increasingly reliant on AI, dynamic pricing models, and algorithmic inventory management, what if CarMax's ultimate competitive moat isn't their physical real estate network? What if it isn't even their consumer brand recognition?
What is the underlying asset then?
The historical data. I mean, they have accumulated 30 years of proprietary transaction appraisal and financing data just sitting on their servers.
Wow.
In an AI-driven future, algorithms are entirely dependent on the quality and depth of the data you feed them. The company with the deepest, most accurate historical data pool inevitably builds the most efficient pricing models.
That is a wild thought.
It is entirely possible that in a decade, we won't view CarMax as a traditional car retailer at all, but rather as an automotive data monopoly that merely uses physical cars as a mechanism to monetize its algorithms.
That reframes the entire business model. Suddenly, the traditional used car lot is replaced by pure mathematical precision. It's a fascinating lens to look through as we watch them execute this pivot.
It really is.
Well, thank you for joining us for this deep dive. Keep questioning the consensus and keep looking beneath the surface of the markets.
This content is produced by Compasscope.com. For more than 1,100 public listed companies, Find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on compasscope.com.